Gotcha. Gotcha.
So traders, I want to make this incredibly simple following the 3-step process that we talked about in the previous video. So make sure you subscribe. In fact, I'm going to make this so short, so simple to understand. You're gonna grow consistently, you're going to make a lot of money, but I have nothing to sell to you. I'm here to provide value. I want you guys to join the 1%. But if you fail to understand this simple concepts here, discount, equilibrium versus discount, it's very simple. If you fail to understand, it's going to be the reason you will quit. In fact, I've grown very many accounts. Y'all have seen the examples I've taken through, the live examples I've taken through, guys. That being said, I can't wait to help you grow. So example number one. So we have a swing low, swing high. We bring our Fibonacci, we place our Fibonacci from the swing low here to the swing high. We wait for price to retrace to equilibrium, because that's where the banks buy at, equilibrium or less. So how do you know that this is a swing high? We need 4 candles to tell us that this is a swing high. The first, second, third, fourth. So price comes back to equilibrium. What do? You put your entry right there at the close of that candle, stop loss below. Then you go for your take profit. Take profit is always above the previous high. But that being said, I also have another tool that will show you take profit. So with this Fibonacci still, I have my tools that show me where I take my first take profit and my second take profit. You shall get that in a little bit. So you have to understand at equilibrium has fair value, where price is at fair market value. It's neutral to bullish condition. You're not paying anything. Let me give you another example. So higher high, higher low. So this the low. This will be our new low. So what we do is that we make another low. So you put our first swing low here, then wait for price to make another high, taking out the previous high, taking out the previous liquidity, expansion. Price always expands to liquidity. It takes it out. So what do? Wait for 4 candles. The first candle, then the second candle that makes a high, the third and the fourth that closes below it. Sorry for that. When that happens, wait for price at equilibrium. So for this time, price came back to equilibrium. This is equilibrium here. Price came back to equilibrium, passed through it, but look at where it went to. It went to our sweet spot. Price rallied till the 70.5 level. That's our sweet spot. What happened next? Price rejected right away. So price cannot stay at equilibrium for a long time. That can't happen. It can't stay at equilibrium for a long time. You feel me? The algorithm kicks into buy mode immediately. It's not about the Fibonacci. That's what happens in real time. So price went to do deep discount. It went to this deep discount between the 61 to 70.5. The market will not respond to indicators. I've told you guys many times. Indicators reflect what has already happened, or what has already happened in the market. So the market will rally, taking out the old high into, fast wait. This was supposed to do like this. Sorry guys, sorry for that. Anyways, it's still a what? Okay, 61.8. So the market will rally, taking out the old high. That's what liquidity is. Yeah, after price, when you buy at equilibrium or less, market will expand, and market always expands to liquidity, taking out those old highs in TP1, TP2. Let me take you to another example. Then we shall go into our entry time frames and check for what you should be looking for in our entry time frames. You feel me? We are not done yet. Please. We are not done yet. I've told you guys, if you ignore the steps I'm taking you through, we are done with the daily time frame. We are going to the 4-hour time frame, then the 1-hour time frame. If you ignore or skip any part of this video, it's going to be the reason as to why you are not seeing growth in the market. So that being said, remember I told you guys the first thing to understanding institutional order flow is movement. To be a buyer, there has to be bigger profits, bigger pockets to move price around. It's not a supply and demand factor, it's a greed factor. These banks, these probes want to make money. They are in the making money business. So we should focus on price and price alone, and price will give us everything you will ever need. You don't need indicators, patterns, best ideas for your entries, exits, and stops and take profits. So we have this example here to here. Then we also have this next one here. Let me see. Hi, this is the low. This is the low. Now let me take you guys to it. Let me remove this. Slowly. See this here to this high. So we have this low to this high here. Look at where our price came at equilibrium. What happened? Price bounced right through the old liquidity, took out the equal highs and lows, took out the liquidity that was there, took out everybody. That's what happened. So let's go to the 4-hour time frame. I show you guys in depth what I mean by this. So we have this. This swing low to this swing high. We are going to look at our entries and exits here to this swing high, but let me project this around here so that we get this TP1 and TP2, and I'll be explaining that. So swing low, swing high, price comes at equilibrium. Right away, it just bounces to the top. It bounces to the top. So when price is at equilibrium, here on the 4-hour time frame, you're looking for behavior. So price moved into equilibrium, filling up the liquidity void here, After filling up our liquidity void, it gave us an indecision candle, then a momentum candle. You could have entered right here after price bounced off equilibrium. Or if you missed that, you could use some retrail ideas like the break of what? The break of a downward downward price swing. You see? The break of this, then the retest. Then you could also have entered right here again. So our first entry is always down here at equilibrium here. But since you already understand from the daily time frame that price has already rejected from here, so you can easily miss trades. So you must have missed this first day here. You must have missed that first day. You come back on the second day, you could still enter because we know that price has already retested at equilibrium. So price is going to rally till TP1 and TP2. So we're just going to be buying all the way. So you must have missed the first entry. Then on the second entry, you just do your wages, this and this. Price breaks above, it comes back for the retest. Price moves in with a lot of momentum, gives us indecision, gives us weak rejections. Okay, there's a gap here, but this momentum candle, you enter, stop loss below, and go for the targets above. Or if you didn't want to do that, you could still bring back another Fibonacci. So we already know that we are going up. We already have our bias. Yeah, the first thing is an uptrend. Then you also have the Fibonacci. Then you also had that the price was at equilibrium. If you didn't want to use that, or if you wanted another confluence, look at this. Price comes back at equilibrium. You buy the market. You take your profits above the old high. Simple as this. Yeah, simple as this. Same thing. You could also look at this. You place again. You adjust it to this next swing high. Look at what price did. Price came back to equilibrium. Then put this at equilibrium right there. Price comes back at equilibrium. Below equilibrium. But I told you guys, price does not stay at equilibrium for a long time. I gave you guys that example of when You go to buy steak at a groceries, and the price was initially at $10, then it drops to $8 at a discount. It does not stay there for a long time. Even for a phone, iPhone Pro, iPhone 14 Pro, whatever it is, if the price is $1,000 initially, then for in case of promotion and everything, they drop it from $1,000 to $800. It will not stay there for a long time. It will eventually bounce off. So look what happened. Price came to the 70.5 and rallied back up right straight away. Let me give you, so we are done with that. Let me go back. Let me first move this. Let me show you guys another one. Real quick. So we have this swing low to this swing high right here. Swing low to this swing high, which took out the previous high. So price comes back to equilibrium. See, price comes back to equilibrium, but it goes. Let me expand this so that you guys can see it properly. Price comes back to equilibrium. It goes really below equilibrium. Price reaches a 61.8 level here. Goes below it into almost 70.5, the sweet spot. 70.5. That's why it rejects from. Gives us an entry signal here because we have 1, 2, 3. You can also use the knowledge I gave you guys about the 4 candles. Yeah, the one on the left, then the one that makes the low, then the one that shifts direction, and the one that really closes below it. You could have entered the stop loss below 70.5 and take your break profit. You can still use that idea. You don't need to cram things. You just have to be versatile with what you are doing. You just have to understand it. And one more thing is, price really retested this order block here. Remember from the last example, we have an order block here. The last downward move before the upward move, the last strong one. You have an order block there, which was filled. You have a third of SOP here, and this is also the last downward move before the upward move. So you have 2 order blocks.